Investing while in debt. The psychology behind a risky financial choice. Many people invest while still carrying debt. On paper, it may seem logical. If my investments return more than my interest rate, I win. But the decision is rarely purely mathematical. It is deeply psychological. 1. The optimism bias. People tend to overestimate investment returns and underestimate risk. Expected market return feels certain. Debt interest feels manageable. Volatility is mentally discounted. This is optimism bias at work. Future gains are imagined clearly. Future losses are minimized. 2. The leverage illusion. Investing while in debt is effectively a form of leverage. You are borrowing at one rate, hoping to earn a higher rate. Professionals use leverage carefully with risk management systems. Individuals often use it emotionally. The danger is not just lower than expected returns. It's volatility combined with fixed obligations. Debt is guaranteed. Investment returns are not. 3. Emotional diversion. Debt carries psychological weight. Guilt, stress, avoidance. Investing can feel productive and hopeful. It creates a sense of progress, even if the debt remains untouched. This can become emotional diversion. I'm building wealth, while ignoring structural liability. 4. Identity signaling. Some people associate investing with financial intelligence. Paying off debt feels less exciting. Debt repayment equals defensive. Investing equals growth-oriented. But stability often creates more long-term freedom than early risk-taking. 5. The interest rate blind spot. High-interest debt, credit cards, consumer loans often exceeds realistic long-term investment returns. For example, credit card, 20 to 30% interest. Expected long-term market return, 7 to 10% average. Choosing to invest instead of eliminating high-interest debt is mathematically unfavorable in most cases. The guaranteed return from paying off 20% interest debt is 20%. That is risk-free. 6. Stress and cognitive load. Carrying debt while investing increases mental load. Watching markets. Managing payments. Balancing risk. Financial stress reduces decision quality. Eliminating debt simplifies life and strengthens psychological resilience. 7. When it can make sense. There are exceptions. Low-interest student loans. Mortgage rates below long-term expected returns. Employer 401k match, guaranteed return. Strong emergency fund in place. In these cases, investing while carrying debt may be strategic. The key distinction is interest rate, stability, and risk tolerance. 8. The core question. The real decision is not, can I beat my interest rate? It is, can I tolerate volatility while carrying fixed obligations? If markets drop 30% and you still owe the same debt, will your behavior remain disciplined? Final insight. Investing while in debt feels ambitious. Paying off debt feels boring. But financial strength is often built through removing fragility before adding risk. Debt is pressure. Investing is uncertainty. Before chasing upside, eliminate guaranteed downside. That shift is not just financial. It is psychological stability.